In companies, we put capital at risk to generate returns. And we personally take risk every time we drive a car, fly in a plane, or participate in most types of sport. So let's keep it in mind during this session that when we talk about risk, what we're really talking about is uncertainty. Well, again, here, I'd like to use the definition that risk management aims to minimize unexpected performance variances and maximize value. And trade-offs are important because when you stop for a moment and consider, there are many times when you try to address or mitigate one risk, but you actually then create another risk. Companies should not be changing their strategy every 5 minutes or every 5 months for that matter. Now, it's pretty obvious that all companies need to make sure when they're thinking about strategy and risk appetite that it's in line with legal and compliance. And it's absolutely clear that all of these risks, but particularly the non-financial risks, are closely linked with company culture. Therefore, even where you think strategy and risk appetite are in alignment, board members and management need to ask questions about the assumptions and to run or to ask to look at scenario analysis. One is what happens to the value of the assets or liabilities, but the other thing which came into play in this case is what does that do to market behavior, the behavior of the customers, and so on. Now, I don't know if there were any dissenting views on the board or in the management team about what Silicon Valley Bank was doing. So as time went on, the more and more dives it did, the more risky it became. And that is the angle that I think people were not necessarily aware of. The other thing that would give you comfort if you were going to embark on this trip is that the CEO of the company himself was also on the trip, and he's clearly an expert in this area and was one of the people who died. There was a lot of coverage in the press about the disclaimers that people had to sign before undertaking the trip, and they were very explicit and even talked about death and so on, although whether they truly were aware of the risks, I don't know. And it surfaces a lot of these issues and tensions about risk and do we really know what the risks are and so on. But briefly speaking, what happened was that Swiss Re is a very large financial services company, over 150 years old, the second largest reinsurance company in the world. And they did a contract, structured credit default swap, structured CDS, and that ended up kind of blowing up in the financial crisis to the tune of about $1.6 billion US. And at the same time, on the asset side of the balance sheet, the company had invested in very highly rated, AAA rated, structured mortgage-backed security products, which again started kind of falling apart, coming under considerable pressure as the financial crisis deepened. But the lessons that I think we can learn from this are that financial models are not the only test of risk. One of the reasons why that was an option was that Swiss Re did not sell all its highly rated but very marked down assets at the bottom of the market. They held on to them. So it's important to dig into these signals and ask questions and look at sensitivities and continue to monitor these things when we're thinking about the appropriateness and the alignment of strategy and risk appetite. Unfortunately, given the title of this presentation, we've seen in some examples that alignment of strategy and risk appetite in itself is not sufficient. So this means that the risk function needs to be an enabler of positive risk-taking, and the risk function should be involved in both strategy development and implementation.